Hello, I'm Gill Fielding, and this is what's caught my eye in the media this week. Well, there's been an announcement about mortgage figures and risk and so on this week. So I had a look at that, and there's a big difference between a domestic residential mortgage and an investment mortgage. With a domestic residential mortgage, obviously the providers are relying on the applicant to make the monthly payments, and those monthly payments have to be made out of earnings. And with a squeeze on household spending and costs rising at the moment, then obviously a lot of those mortgage payments are under pressure. Now, with an investment mortgage, it's not quite the same, because in terms of the monthly payment of an investment mortgage, it's paid by the tenant in the main via their rent, and often the landlord will have other investment properties and their own income to fall back on. So it's quite unusual for an investment mortgage to default or to get into arrears. And figures announced by Paragon this week, who are one of our larger buy-to-let mortgage providers, confirm that. And apparently only 0.15% of investment mortgages are 3 months or more in arrears. And that's down from 0.28 a year ago. So even within the pandemic, the amount of payments have kept going. And buy-to-let investors don't get into arrears. So 0.15% of investment mortgages are in arrears. Now, figures vary on the arrears on domestic residential mortgages, but it's several percentage, maybe 3-4% of all domestic residential mortgages are 3%, 3 months or more in arrears. And that's because the applicant, the person who has the domestic residential mortgage, is feeling all kinds of financial pressures that investment mortgage owners, landlords don't necessarily have. So it's quite an interesting stat. So that's why mortgage providers much prefer investment mortgages and investors rather than domestic residential purchasers, because the risk is less for them. Now, it's interesting because the man or woman on the Clapham omnibus, the normal person in the street, thinks that investment mortgages are risky. Not for the lender, they're not. So the next thing I looked at was tracker funds. Now, I've always been a fan of tracker funds, and if you've heard me talk about share investing or read anything that I've ever written about it, tracker funds will always come up. And a tracker fund is where a fund, a general pot of money, just tracks the stock market as a whole, or a specific index within the stock market, like the FTSE 100. It's very easy to do because all that happens is a computer takes the money that's available and buys all the shares that are listed on the FTSE 100, if that's the index we're looking at. So it's very easy to do. And as a consequence, it's very cheap to manage and organize. And so the fund management fees that an investor like you or I will pay on a tracker fund are minimal. Sometimes it's even 0.1%, certainly less than 0.5%. Now, if we gave our money to an actively managed broker or an actively managed fund, then the fees that we would pay would be much higher, certainly a couple of percent, maybe even as much as 5%. And of course, what we're asking the broker to do in that particular case is outperform the market. And although that can be done from time to time, it can't be done consistently and for the long term. So actually, tracker funds work for me, and they've always worked for me, and I've had my children's money invested in tracker funds for a long time. Now, it turns out that a lot of people are coming around to that type of thinking, and in the last 10 years, the proportion of money invested in tracker funds as a proportion of investment funds overall has gone up from 8.4% to 19.8%. So nearly 20%, a fifth of all money is now invested in tracker funds, and it's obvious to see why. The fees are lower, it's easier to do, it's easy to get in and out. Anybody can do it. You can do it with a small amount of money or a large amount of money. It doesn't actually matter. And the evidence is there for us all to see. Because in the first half of this year, £468 billion of money was withdrawn from actively managed funds, and a fair chunk of it, 256 billion, ended back in tracker funds. So people are moving from actively managed funds into tracker funds, and it's easy to see why. Tracker funds are cheap at a time when people are feeling the pinch on all costs. Easy to do, easy to get in and out. It tracks the market, and it's very rare to do anything better than that on a consistent basis. So it works for me. I like tracker funds. I also like interest rates, and I monitor interest rates avidly all the time. And the Bank of England have set interest rates since 1694. Now, in case you ask, that's long before I started investing, but only just. So interest rates have been set by the Bank of England for over 300 years or so. And in all that time, the average interest rate over that whole time since the 1690s has worked out at 5.9%. And if we look at the last century, the average interest rate has been 5%. So I feel very comfortable with the level of interest rates we're at the 1% and slightly above level. Movements like 1/4% or even 1/2% don't really bother me because we're still way below the running average either over the last 100 years or the last 300 years. And it gives me confidence as an investor because I always use 5% as my base figure when I'm calculating or planning or doing a budget for a particular purchase of a property. And of course, 5%, if it's worked for the last 100 years, it'll work for the next 6 months. So I'm very comfortable with that. So it gives me perspective. It makes me feel comfortable because I know that overall we're well within the last 300 and so years worth of interest rates. Now, I hope you've been watching the Commonwealth Games. I have avidly. I'm a real sports watcher. And the England anthem is Jerusalem. And there's a line in there that says we live in a green and pleasant land. And we do. It's often talked about that we haven't got enough land for building, but we have. We actually build on a very small proportion of the land that's available to us. It's certainly less than 10%. The figures vary. Some people say it's 8%, but it's around that kind of level. So only 10% of our land is ever built on, and the rest is green and pleasant land or maybe brownfield sites. And I mention this because in the recent Conservative leadership run-up, there's been mentions about building, of course, and building houses and the land that we have available to us. And apparently there's been an outcry about the fact that since 2014, 60 square miles of land have been allocated by councils to building. Now, that sounds like a big number, but it's quite small when you consider that they've got 6,232 square miles left available to the councils. And since 1979, the Green Belt, the area that we know as the Green Belt, has more than doubled in size and covers an area 10 times bigger than all the land we've ever built on. Now, if we add into that, national parks and areas of outstanding national beauty, that kind of thing, it turns out that all of that space, all of that green space comes to over 30 times more than all the land we've ever built on. Now, I'm an environmentalist and I definitely don't want everybody building everything everywhere, and I don't want that running away like Topsy. But it would be quite possible for us to double our housing stock and still have 80–85% of our country left as green and pleasant land. It would be doable. It's got to be sustainable. It's got to be environmentally friendly. It's got to be carefully planned, but we can still have all of that housing and live in a wonderful green and pleasant land. Now, the other thing I've been watching this week, of course, is the football, and I'd like to give a shout out to the Lionesses. It was a fantastic game. I've enjoyed watching the whole thing. It's lovely to see women playing football and enjoying it and being joyful about it. Of course, they are nowhere near the level of the men's teams. I accept that. I've been a football watcher for 40–50 years or so, and the standard has got some way to go. Mind you, that's partly the FA's fault because the FA banned women's football in 1921 for 50 years. So we've only had women's football back officially since 1971. So we've got some way to go. And that difference is demonstrated by the financial inequality of how the teams are rewarded and so on. So Leah Williamson, the women's team captain, earned about £200,000 last year, whereas Harry Kane, the men's football captain, earns £200,000 a week. So there's a massive difference there. But I imagine that gap is going to start to close because 17 million people watched the women's Euro final last weekend. compared to about 30 million that watch the men's game. So we're about 55, certainly well over half of the viewing public compared to the men's game are watching the women's game. And of course, advertisers and sponsors will see that and see that there's a space that they can get into. And so they will start pumping money into the game. Now that money has to go down to the grassroots. We have to encourage everybody that wants to play if they want to, and that can be young girls and even older women like me who want to have a go at football. So we have to get the money back into the game. And of course, we do have to start rewarding the players for being brilliant and outstanding and the best in the country at what they do. So £200,000 a year or £200,000 a week, huge disparity. I hope that gap closes and closes rapidly. Money is a great leveler, and it indicates when money is unequal, it indicates inequality in our society. Money's a great leveler. We've got a long way to go. Let's hope we get there. And well done, the Lionesses.